At its peak, Enron was worth about $70 billion. Fortune magazine named it America's most innovative company 6 years in a row, and Wall Street treated its executives like rock stars. Then, over a few weeks in late 2001, it became the largest bankruptcy in American history, and the smartest people in finance finally admitted something embarrassing. They had never actually understood how Enron made a single dollar. 20,000 people lost their jobs. Most lost their retirement savings too. And the wild part is that the answer was hiding in the financial statements the whole time. Nobody wanted to read them. Before this is over, you're going to see an accounting trick that let Enron count money it hadn't earned yet, money it might never earn, as profit today. You're going to meet a finance chief who built secret companies on the side, ran them himself, and used them to hide his employer's losses while personally pocketing tens of millions. And you're going to see the single question one magazine reporter asked in print 8 months before the collapse. That should have ended the whole thing on the spot. The people at the center of this didn't get away with it. The chief financial officer pleaded guilty. The CEO was convicted and sentenced to decades in prison. This isn't a theory, it's a matter of record. Let's kill the easy explanations first. Enron didn't die because energy prices moved against it. It wasn't one catastrophic trade, and it wasn't a recession. The thing that killed Enron was built into how the company reported its own success, year after year, in plain sight, signed off by one of the most respected accounting firms on earth. To see it, you have to understand the magic trick at the center of the company. Enron started in 1985 as something deeply unglamorous, a natural gas pipeline company in Houston, pipes in the ground, gas flowing through them, boring, steady, real. Its chairman, Kenneth Lay, wanted to be something bigger than boring. So through the 1990s, Enron reinvented itself, first as a trader of energy, then as something it claimed was entirely new, an asset-light company. The idea was that Enron wouldn't need to own power plants or pipelines at all. It would simply make markets, buying and selling energy, then bandwidth, then advertising space, then weather. In 1999, it launched Enron Online, a slick web platform for trading all of it, and Wall Street fell in love. This wasn't a stuffy old utility anymore. This was a technology company. The market rewarded the story. By August 2000, the stock hit around $90, valuing Enron near $70 billion. It was the 7th largest company in America. Its executives, Lay and his deputy Jeffrey Skilling, were treated as visionaries who had figured out the future of business. There was just one small problem with the future they were selling. A lot of the profit underneath it didn't exist yet. Here's the first device, and it's the heart of everything, so stay with me. Normally, a company records revenue when the cash actually shows up. Enron didn't want to wait. It used something called mark-to-market accounting. When Enron signed a long-term deal, say a 20-year contract to supply energy, it was allowed to estimate the total profit that deal would make over its entire life, and then book all of it as earnings right now, today, before a single dollar had arrived. Think about what that means. Enron's reported profit wasn't money it had made. It was management's own guess about money it hoped to make, sometimes decades in the future. And because they were guessing, they could guess generously. Every quarter, Enron could conjure earnings out of optimistic projections, hit its numbers, and watch the stock climb. But projections have a nasty habit of meeting reality. When a deal underperformed, and many did, the profit Enron had already reported simply never showed up. The company had spent earnings it never earned, so now there was a gap, a growing hole between the profits on the books and the cash in the bank, and that hole had to go somewhere it couldn't be seen. That's where the second device comes in, and this one is audacious. Enron's chief financial officer, Andrew Fastow, built a web of separate companies, partnerships with names like LJM, and a set of entities nicknamed the Raptors. On paper, they were independent. In reality, they existed for one purpose: to swallow Enron's losses and debt so they disappear from Enron's own financial statements. A failing investment, a pile of debt, anything ugly, Enron would sell it into one of these partnerships, and just like that, the books looked clean again. Now here's the part that should stop you cold. Fastow didn't just create these partnerships, he ran them. The same man who was supposed to guard Enron's money was on both sides of the deals, and he personally made around $45 million doing it. And there was one more flaw, the fatal one. These partnerships, the safety net catching all of Enron's losses, were themselves propped up with Enron's own stock. So the entire structure only worked as long as Enron's share price kept rising. As long as the stock went up, the partnerships could absorb the losses, which kept the reported earnings looking great, which kept the stock going up. A perfect, beautiful loop. You can already see the problem. The whole machine was a bet on Enron's own share price. And the moment that price started to fall, the loop would run in reverse, and every loss they had hidden would come crashing back at once. Some people did read the statements. A short seller named Jim Chanos looked at Enron's filings in late 2000 and couldn't reconcile them. Enormous reported profits, almost no actual cash. In March 2001, a Fortune reporter named Bethany McLean published an article with a headline that was really just a question: is Enron overpriced? Inside, she asked the one thing no one at the company could answer in plain English: how exactly does Enron make its money? Enron's response was not to answer, it was to attack. On one now infamous earnings call, when an analyst pushed for an actual balance sheet, Skilling called him a profanity on the record, and much of Wall Street laughed along. The arrogance was the brand. Then the brand cracked. In August 2001, Skilling, who had just become CEO that February, abruptly resigned after only 6 months, citing personal reasons. That same month, an Enron vice president named Sharon Watkins wrote Ken Lay a private memo. Her words: "I am incredibly nervous that we will implode in a wave of accounting scandals." She was right. She was also ignored. The fall, when it came, was astonishingly fast. On October 16, 2001, Enron reported its first quarterly loss in over 4 years and took a $1 billion charge. Days later, it admitted a $1.2 billion hit to shareholder equity, tied to Fastow's partnerships. The SEC opened an investigation. Fastow was fired. On November 8th, Enron restated its earnings, confessing it had overstated profits by around $586 million going back to 1997. The hidden hole was finally on the table. A rival energy firm, Dynegy, briefly agreed to buy Enron, then looked closely at the books and walked away. The credit agencies cut Enron to junk. Its trading partners vanished overnight because no one trades with a company that might not exist tomorrow. On December 2, 2001, Enron filed for bankruptcy with $63.4 billion in assets, the largest corporate failure America had ever seen. The stock that had touched $90 a year earlier was worth pennies. The damage spread outward. Around $74 billion in shareholder value gone. 20,000 employees out of work, their retirement accounts, heavy with Enron stock and frozen during the crash, mostly destroyed. And Arthur Andersen, the storied accounting firm that had blessed Enron's books, was convicted of shredding documents and collapsed, taking 85,000 more jobs with it. It's tempting to file Enron under greed and arrogance, and there was plenty of both. But the greed isn't the engineering failure. Here's the real one. Enron built a company whose reported profits were a bet on its own stock price. Mark to market, let it print tomorrow's hoped-for earnings as today's results. The secret partnerships let it hide the shortfall when tomorrow didn't deliver. And those partnerships were backed by Enron's own shares, so the higher the stock climbed, the more losses the company could bury, which kept the earnings glowing, which kept the stock climbing. It was a circle that produced the appearance of profit out of nothing but belief. A real company makes more money than it spends. Enron made a story that was only true as long as everyone kept believing it. That's the same disease that would later kill Terra, whose stablecoin was backed by its own token, and FTX, propped up by a coin it printed itself. Enron was the original. It backed its own losses with its own stock and called the result profit. So here's the lesson, and it has outlived Enron by decades. When something is described as too innovative to explain, when the smart money insists you just don't get the new model, ask the dumbest possible question and refuse to leave without an answer. Where does the cash actually come from? Not the projected cash, not the earnings, the cash. If no one can tell you in a plain sentence, you are not looking at innovation, you are looking at a story, and stories end. Enron didn't fall because the world was too complicated to understand it. It fell because the world finally insisted on understanding it, and there was nothing underneath. Enron pretended an energy company was a technology company, and the smartest people in the world believed it for years. 2 decades later, a college dropout pretended she had built medical technology that didn't exist, and fooled even more of them, including some of the same names. Same spell, higher stakes. That story is already on the channel. The link's on screen.